coming up on Global Business. Milestone achieved. China's domestically developed C919 large passenger aircraft completed its maiden international flight on Wednesday, landing safely in Ulaanbaatar, capital of Mongolia. Data watch. Markets are keeping a close eye on the latest consumer inflation figure from the U.S., looking for clues on the Fed's next policy move. That is, after surprising job growth numbers last week. Supply shock. The International Energy Agency sharply reduced its forecast for global oil demand this year as supplies remain crimped by the closure of the Strait of Hormuz and buyers deterred by high prices. It's good evening from Beijing and welcome to this edition of Global Business on CGTN. I'm Lily Lu. China's domestically made C919 aircraft successfully completed its first international commercial flight on Wednesday, operated by Air China. The flight connects Beijing with Mongolia's capital Ulaanbaatar. Our reporter Yo Yang has more.
The launch marks a major milestone for the C919 as it becomes the first regular international commercial passenger route operated by the aircraft.
It's wonderful, so nice. Everything is good and facilities is very nice.
I'm really excited. I heard it's the first time international flight of this CA723, right? Yeah, I'm really excited. I'm with my family, everybody's here, so it's gonna be fun. Yeah.
Landing at the airport in Ulaanbaatar, the plane received a water salute, a tribute of respect and honor used to celebrate achievements and milestones in the aviation industry. Representatives from the Chinese embassy in Mongolia, as well as officials from Mongolia's transport and aviation sectors, also came to the airport to welcome the arrival of the C919.
This is
indeed the first time for the C919 to fly an international route. As the captain operating it, I feel very proud. We have chosen the most skilled pilots in our fleet to carry out the maiden flight work, and we have made careful preparations to make sure the flight will be operated successfully.
The C919, manufactured by the Commercial Aircraft Corporation of China, or COMAC, made its first commercial flight on May 28, 2023. Since entering service, the aircraft has steadily expanded its operations across China. As of 2026, all three major Chinese airlines, including China Eastern Airlines, Air China and China Southern Airlines, operate the C919. Over the past 3 years, the aircraft has safely carried more than 7.5 million passenger trips, serving routes between more than 20 cities.
I believe from domestic routes to regional and international routes, the expansion of China's domestically made aircraft came from the full effort of our civil aviation personnel. As a pilot, I also feel the great responsibility on my shoulders of flying our C919, well as part of routine work in the future.
Experts say the choice of Ulaanbaatar as the C919's first regular international destination reflects a combination of factors, including long-standing aviation cooperation between China and Mongolia and existing arrangements for airworthiness certification. And they believe the new route will also help establish the C919's overseas support capabilities, including maintenance cooperation, spare parts arrangements and international operating procedures. These capabilities will be crucial as the C919 expands beyond the Chinese market, and the new route is expected to lay a solid foundation for the aircraft's future development in international markets. Yo Yang, CGTN, Beijing.
Shifting gears, China's auto exports are shifting into a high gear, with shipments topping 1 million vehicles for the second consecutive month. The China Association of Automobile Manufacturers says the country's auto exports jumped over 81% on year. New energy vehicle exports grew even faster, reaching 553,000 units. That is up more than 145% from a year earlier. The strong growth is backed by China's highly integrated auto supply chain. Smart technologies are also becoming a key competitive edge, with features such as intelligent driving and smart cockpits rapidly evolving to meet the needs of overseas consumers. Chinese automakers, including BYD and Geely, are building local factories in Brazil to tap the fast-growing electric car market. CGTN's Paulo Cabral reports from Camacari, Brazil.
Chinese car makers are taking root in Brazil's electric transition, not just selling cars but building them here. BYD is the biggest example so far. At this factory in northeastern Brazil, the company says it has reached a milestone, 100,000 cars produced locally since opening in October 2025, making it BYD's largest production base outside China. And the plans go beyond Brazil.
The factory here, I think at this moment probably only support the market in Brazil, but probably next year we can start to support the other South American countries like Argentina or the other South American countries.
And do you see appetite in other South American countries for your electric vehicles?
Yeah, I think for electric vehicle you can see in Brazil it's really successful, and also we can see the other countries is growing also very fast. We believe this market will grow, continue to grow, and also to have a really good market share.
And it now runs with 5,500 local employees, according to the company. Job creation is a key measure of success for the community here, as the region felt the heat when Ford left and thousands of positions disappeared back in 2021. The mayor of Camaçari is hoping for positive impacts in the city well beyond the direct creation of jobs.
What we need now is planning and organization, so that big capital also help the city's micro and small businesses, creating opportunities for those small players to take part, especially in the service sector.
BYD played a key role in opening up Brazil's market to electric mobility, but the potential of the Brazilian and South American markets has been attracting other Chinese automakers too. And many are not just shipping cars to Brazil. They are investing in factories, partnerships, and long-term plans.
Some are coming in through partnerships with car makers already established in the country. Geely stands out. The company has been challenging BYD's lead in China's domestic overall car market. Now, less than a year after arriving here in Brazil, it's also pushing the competition in the country's EV market. It's already second in the sale of 100% electric vehicles in the country, although still well behind the leader, with less than a third of BYD's total in the first half of 2026, but significantly ahead of other competitors. Geely bought a stake in Renault's Brazilian operation last year, so it sells and offers after-sales services through the well-established French car makers dealership network, and will soon build its cars at the Renault plant in the state of Paraná.
They have the factory, they have the dealership, they have the financial company, and they have the team. The team is very complete. Yes, it's very important. Because you have the factory, so the customer, they will more believe in you. They will understand, oh, you have the plan to stay here. If you only have the operation to import the vehicle, so it's no long-term plan.
Specialists say the rush for local production also carries a regulatory element. Brazil has been gradually raising import tariffs on electric vehicles, reaching 35% this month. Producing locally reduces that burden.
Ainda tem uma alíquota especial.
Companies that don't build factories here will have to pay that 35% import tax. Whoever falls behind will take the full 35% hit. No mercy.
For now, BYD leads the market it helped open, but it can already see the rivals in its rear-view mirror, pushing to close in. Paulo Cabral, CGTN, Camaçari, Brazil.
And China's electric heavy-duty truck industry is accelerating at an unprecedented pace. The country already operates the world's largest fleet of electric heavy trucks. Sales surged nearly 80% in the first half of the year, and by 2030, China aims to have 1.6 million of them on the road. CGTN's Huang Fei looks at how the country is scaling up electric freight transport.
Heavy-duty trucking is one of the toughest sectors to decarbonize. Bigger batteries mean more weight. Longer charging means lost time. And in logistics, time is money. But China believes it's found a way around that. The country plans to build more than 3,000 charging and battery swapping stations along key freight corridors and logistics hubs by 2030. In Guangdong, the latest megawatt charging technology can deliver around 100 kilometers of driving range in just 5 minutes. These next-generation chargers not only supply power, but also cool the equipment, keeping them operating efficiently, even in extreme weather. For fleet operators, that means lower operating costs, reduced maintenance, and faster turnaround. And those advantages extend well beyond long-haul transport, benefiting heavy trucks working in ports, mines, and other high-density industrial operations.
The plan also covers freight hubs, ports, mining areas, factories, and industrial parks, with a goal to link these facilities into a well-connected and coordinated network.
Government incentives are also making the transition more affordable. Buyers can receive trade-in subsidies of more than $20,000 when purchasing a new electric heavy truck. This year, China has earmarked another $3 billion in ultra-long special treasury bonds to help retire older diesel trucks. The environmental impact is significant. Heavy-duty trucks account for nearly 40% of emissions from China's transport sector, making them one of the country's biggest opportunities for carbon reduction. And China's approach is now going global. The country recently exported 880 electric heavy-duty trucks in its largest overseas shipment to date. According to the manufacturer, the fleet could save customers around $22 million in annual operating costs, while reducing carbon emissions by roughly 80,000 metric tons each year. The question was never whether electric heavy trucks could work. It was whether they could be deployed at scale. China's experience may now provide a roadmap for other countries looking to electrify freight transport. Huang Fei, CGTN, Guangzhou.
And still to come here on Global Business. The International Energy Agency sharply reduces its forecast for global oil demand this year as supplies remain crimped by the closure of Strait of Hormuz and buys deterred by high prices.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business. Only on CGTN.
And here's a quick look at some other business headlines that we're tracking at the hour. The U.S. officially revoked its 2023 ban on TikTok use across federal government devices on Monday. Authorities confirmed that platform no longer poses a national security risk following its U.S. business restructuring and a conclusion backed by a formal opinion from the Justice Department. And vessel traffic through the Strait of Hormuz fell to a one-week low on Tuesday as escalating regional conflicts prompted ship owners to steer clear of the waterway. Transit volumes remain far below normal levels. And in Norway, the country's $2.3 trillion sovereign wealth fund, that's the world's largest, posted a record first-half profit of $184 billion in 2026, driven largely by surging Asia technology stocks. The U.S. Consumer Price Index, which is a key gauge for the country's inflation, was up 3.4% in July on a yearly basis, slowing from June's reading, but still well above the 2% target. Volatile energy and food prices remain major drivers of inflation, despite some analysts saying that America's position as a net oil exporter helped to stabilize prices at the gas pump. Labor Department data showed that the core inflation stripping away food and energy only edged up 2.5% last month. The numbers are in line with market expectations. And speaking about oil markets, the International Energy Agency, the IEA, sharply downgraded its global oil demand forecast for this year on Wednesday, citing the ongoing closure of the Strait of Hormuz and surging energy prices. The IEA now projects demand would slump by 1.6 million barrels per day, a steep drop from its previous estimate of 1 million just a month ago. While the Middle East conflict continues to weigh on consumption, the supply side has been held relatively well, at least for now. U.S. giant ExxonMobil and Chevron both posted strong second quarter earnings, largely driven by elevated oil and derivative prices. U.S. President Donald Trump has accused the two companies of profiteering and also urged them to return a portion of their windfall to the American public. And now for more discussions on fallout from higher oil prices, we're now joined by Stephen Innes, global strategist at Quintex Intel, a financial consultancy that's based in Bangkok. Mr. Innes, thank you so much for being with us. So oil majors, reap record windfalls, yet household energy bills are still rising amid Middle East tensions. What do you think is the root of this uneven structural imbalance?
Well, a big part of the imbalance sits in refining, what they refer to as the crack spread, which is simply the margin between the cost of crude oil and the value of gasoline, diesel, and other products made from it. When refining capacity is tight and product supply is disrupted that we have right now, those margins can widen sharply. This is allowing integrated oil majors to benefit from both stronger crude prices upstream and richer downstream prices. So it's almost a positive feedback loop for the oil majors. However, as we know, when we go to fill up our car at the pump, it's a real negative for consumers.
So if the Strait of Hormuz faces prolonged blockage, what major buffer mechanisms can the global oil systems rely on to offset supply shortfalls? I mean, that is given that global strategic petroleum reserves already have been depleted after repeated releases.
Yeah, this has been the biggest supply conundrum that we've been dealing with ever. I do believe in the oil markets. I think the global system still has adequate buffers. There's no question. And importantly, this is not 1990 oil shock again. The world is heavily was dependent on crude back then. But now there's a much broader energy mix, and alternatives now matter much more. I mean, let's face it. Nowhere is that more visible when I travel to China, for instance, or even Hong Kong. The scale of EV adoption is absolutely striking. That just reduces the intensity of parts of the economy. On the top of that, as you mentioned, we've had the SPR releases. Yes, we're getting near the tank bottoms, but they've helped absorb the initial wave of the shock. And we also revert back to China again, where they have been drawing more heavily on domestic oil reserves rather than topping up inventories or chasing replacement barrels. And this has been probably the biggest factor that's alleviated the higher oil prices. However, as these stocks and become depleted, it puts more pressure on prices themselves, and it forces prices higher. And eventually we reach a point of higher oil prices where demand destruction takes off, and that does tame the price. What demand destruction is how consumers react to these higher prices. They tend to back off quite aggressively on a lot of purchases that are integrated in the oil market. And I think this is part of the IEA's argument why they're seeing anticipating lesser demand for oil in the next little while.
Indeed. How long do you think will geopolitics override the fundamental supply-demand dynamics to dictate oil prices trends, and what kind of spillover impacts it will bring to central bank policy moves?
This has been unusual because Middle East never seems to rest, and that's part of the problem that we have trying to anticipate where oil prices will be. We're in a situation where not only geopolitics, but it's physical flows, it's shipping inventories. All these costs are all adding up together, and you put all those together, and it's just a vicious circle. I think consumer behavior will dominate, and as I mentioned, the best cure for higher prices is higher prices themselves. But getting back to the central bank conundrum, and this really is a conundrum right now because this is a supply-driven shock. Monetary policy is quite ineffective at taming this type of inflation. And I think what the central banks are really worried about is if the oil shock itself starts moving into other parts of the economy, i.e. driving wage pressure higher and all other aspects of food and beyond the oil price, beyond the pump itself. This is where central banks get worried, and this is why they may move into a tightening bias, but eventually that tightening bias is going to curb growth, and they'll end up having to cut interest rates even more. You know, there's a bigger argument out here that central banks should just sit back and let this work out, and eventually we have our fingers crossed that we'll see peace in the Middle East and things will return, but they're never going to return to normal as far as I'm concerned.
Interesting points. Thank you so much. That's Stephen Innes, global strategist at Quintex Intel for us. And the prolonged U.S. conflict with Iran has kept energy prices elevated and disrupted global oil supplies. The Trump administration has turned to the country's emergency oil stockpile in an effort to ease the pressure. Jim Spellman reports from Washington, D.C.
There were about 415 million barrels of oil in the U.S. Strategic Petroleum Reserve when President Trump began attacking Iran back in February. There are now fewer than 300 million barrels as the ongoing conflict continues to put stress on global oil supplies. In March, President Trump ordered the release of 172 million barrels from the reserve, hoping increased supplies would lower gas prices. Before the war, Brent crude was trading at about $70 a barrel. It has since peaked at well over $100 several times and has been trading between $80 and $90 a barrel in recent weeks. Elevated oil has driven up gas prices, rippling through the larger U.S. economy, creating a political liability for Republicans heading into congressional midterm elections. Trump says the pain is temporary.
As soon as this situation ends with Iran, oil is going to go down to the floor. Gasoline is going to go down. We may have to send it up again. We may have to, you know what happens when we send it up, but we hope we don't have to. But when that oil and gasoline go down, everything else follows.
But some experts warn that even if the war ends, the Strait of Hormuz is fully reopened and oil prices fall, it could take months for the price at the pump to come down, meaning U.S. voters may still be feeling the pinch as they head to the polls in November. When the current release is complete, the U.S. Strategic Petroleum Reserve will contain less than 250 million barrels. The minimum amount of oil required by the reserve is about 70 million. Jim Spellman, CGTN, Washington.
And shifting gears to Europe, the global energy crisis is putting farmers in Austria under pressure. The Austrian government is responding with diesel subsidies worth over $100 million for agricultural and forestry machinery. Johannes Pleascherberg reports from Vienna.
High diesel prices have forced Maria Trunner to reconsider her business decisions. 12 years ago, she took over her father's wheat and soybean farm. Back then, however, growing these machinery-intensive crops was far less expensive.
The extra costs you're facing now are enormous. A tractor like this one holds just over 200 liters of diesel, and that only lasts a full day of working when you're plowing.
Some relief is on the way. The government has introduced a subsidy of 18 US cents per liter for farmers, covering both this year and next year.
It's brilliant that the diesel subsidy is coming now. Otherwise, many farms wouldn't be able to find the cash to pay for the fuel before the harvest.
But there may not be much of a harvest after all. Over the past 6 months, many regions of Austria have experienced their driest conditions in 140 years.
Behind me, the drought has left its mark, with experts saying harvests could be down by as much as 30%. Add increased diesel and fertilizer costs, and farmers are saying their livelihoods are under threat.
I think this year has been an extremely difficult one. We're experiencing severe droughts, and of course we would have liked to see more financial support for farmers. But with tight budgets, we have to be grateful that we managed to secure any support at all.
Despite the diesel subsidy, the cost of running tractors remains too high for many farmers, prompting some to move away from wheat production and towards vegetable crops that require less machinery.
If there are alternative crops that require less use of the tractor, it might well be more financially viable.
But vegetables also require more rainfall, something that has been in short supply this year. Difficult times for farmers in Austria and across much of Europe. Johannes Pleascherberg, CGTN, Vienna.
Mexico has begun an energy transition plan towards more renewable energy. The plan opens door for private investment, but more challenges lie ahead. Alastair Baverstock has more from Mexico City.
In the country's biggest push towards renewable energy yet, Mexico's government has put more than $43 billion worth of infrastructure contracts out to tender. Part of the country's goal to achieve a 10% increase in its electricity generation by 2030, with 70% of that increase from clean sources. For consultants in Mexico's energy sector, like Rosaletti Barrios, it's a vital step forward.
Over the previous 6-year presidential administration, Mexico had no electrical development at all. Construction of power projects stopped, and the door was closed to private investment. Demand kept growing while supply didn't, and that has caused blackouts.
The new project, part of President Sheinbaum's Plan Mexico, aims to bring more private energy investment into the country. Marcos Ripoll is the founder and CEO of Solar 180, a company specializing in solar panel infrastructure. His company has sought to participate in the contract tender, but it hasn't been a straightforward process.
We have applied for projects, but the conditions have been tough. Suddenly, they call you and say, tomorrow, you need to submit this, the next day, that. Guarantees, letters of credit, proposals, budgets. Everything seems very rushed.
Ripoll says given the uncertainty around how Mexico's state institutions will work with private sector energy companies, the contract tender has favoured larger companies. Barrios agrees.
Has there been interest from private investors? Yes, but only from those who can tolerate the risk. And they do that by charging higher costs. But that has an impact on our national development and ability to attract international investment because power will be more expensive.
While Mexico seeks to partner with the private sector for energy generation, the next biggest problem, moving the electricity to the end consumers, remains a challenge entirely for the state. For Mexico, building the power plants may be the easy part. This country's aging grid, the transmission lines to carry all this new energy, has barely grown in a decade. Until that changes, the country risks generating clean electricity it simply cannot deliver. Alastair Baverstock, CGTN, Mexico City.
And with that, I'm wrapping up this edition of Global Business on CGTN. I'm Lily in Beijing. Thanks for watching. Bye for now.